Everybody stand back. The stock market decided to crash today and I'm going to do analysis on it. This video comes in 3 parts. Part 1, hello. Part 2, the quick recap. Tech been selling, defensive's been rocking, the middle class been fucking getting screwed by the Fed, inflation, politics, the market, and avocado prices. Part 3, the show. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and what we saw today was just a continuation of yesterday, but even more risk off from growth. And really the rotation into defensives clearly continued, but we really are starting to see it take shape. Now, apart from Apple, which saw upbeat action after its earnings, and I think, also just a flight to quality, we saw red in every other sector: software, semiconductors, infrastructure, comm services, financials. However, credit services fared far better than the rest of the market. Again, that probably had to do with MasterCard's earnings. Discretionary, industrials, it was red everywhere except certain parts of healthcare as well as certain parts in real estate, but real estate was very mixed. Utilities was very green, and likewise here with consumer staples. Very green in the defensive components of the stock market, very red in the cyclical components. Discretionary, tech, energy, financials, industrials, these were all down 2%. Materials down nearly 2%. Comm services down 1.6%. Healthcare was actually in the red today, and then real estate, utilities, and consumer staples, just completely defensive stocks and stocks that'll benefit the most from rate cuts. They gained today, and real estate was only up 0.1%, utilities up 0.2%, and consumer staples couldn't even inch out 100 basis points worth of gains. And across the spectrum, everything got sold. Large caps, mid caps, small caps, with these high beta risk assets in small caps really taking the brunt of the move. Down 3.5, 3.5, and 3.7% here in small cap growth. And even the best performing sector, you think large cap value, really took it on the chin today, down 1.3%. It was a brutal day across the board. A lot of the move happened early. We gapped down and then continued to sell after the NFP print, which, to put it lightly, was an absolute dumpster fire. The consensus expectations for NFP was 175. We came in at 114. It wasn't just that though. There were 29,000 revisions for the prior month. Unemployment rate increased to 4.3%. The expectation was 4.1%. That did mean, however, stuff like average hourly earnings on a month-over-month and year-over-year basis, as well as average weekly hours, did come in a little bit softer. That probably will accelerate the disinflation picture. And labor force participation did pick up ever so slightly, but this was a terrible print. It was really bad. And that further accelerated the motion we saw yesterday. The market's getting a bit jittery that maybe Jerome Powell took too long to cut. Maybe the Fed took a bit too long to cut rates. And now the hiking cycle that was supposed to just temper inflation is now actually having a tangible effect on the economy, growth, and by extension earnings. And I think this data right here puts at least 125 basis point worth of a cut in the next meeting, potentially even 50 basis points. And after that NFP print, fund flows and zero DTE traders took us lower. We did actually find a bottom here, 1130 across all of these indices, both in the Russell 2000, Nasdaq 100, S&P 500, and the RSP. And then we did actually move higher for the day, but the RTY was down 3.6%. The Nasdaq 100 was down 2.38%. The S&P 500 and the RSP were down 1.84 and 1.7%. And the outperformer here today was actually bonds, long duration, TLT up 3.1%. After yields took a huge move down, the 10-year yield was down 4.63% today. The 30-year yield was down 3.95% today. The big mover, the 2-year yield, an absolute dumpster fire, 6.36% move in yields. Yields are literally having multi-sigma events. That is crazy. We also saw volatility spike in a very big way, up 25% today, getting as high as 30. Bonds gained, the dollar fell, Commodities fell except for silver, and equities of all shapes and sizes got sold off and are all approaching very critical levels. The SP 600 approaching this very key critical level of support it's built this year. Mid-caps getting close to the 2950 area. We did see a big impulse from the bottom though. That is some respite for the bulls. The RSP was the best performing sector, down only 1.72%. We can see we are trading back in this balance zone that we sort of were in for most of June and July. This is in the context of us having gone and made a wick all-time high, not quite closing at that all-time high level. The IWM was an absolute dumpster fire, almost erasing all of its gains here in the bid up, but not quite all of the gains from the low right here. But, you know, very similar to the SP 600. We're sort of back in this balance zone right here. So this tailwind in the IWM, the market's going to have to work really hard to get that back. The Nasdaq 100 continues its fall, and on a peak to trough basis, this index has now pulled back 11.75%. That is absolutely crazy. Definitely in correction territory after the close today, down 10.9%. I personally think this is a great zone to buy at, because if we actually just remove this, you could see that the bulls did come in right here, the exact same place we came in right here, and found resistance at that level in early March. If we actually just draw a line, we're at a very critical zone. You could see that resistance turned into support, and now we want to see support right here. And then looking at the S&P 500, guys, look at where we bounced. These are our gamma levels for the day. 5300 was our put support zone. That's our core resistance at 5750. I think it did move down ever so slightly. I need to get the most updated figure. We are in negative gamma, but we bounced here at the put support at a very critical level. So we did find support. Look at this wick, a huge wick off the lows. The question we have to ask now is, does the put support stay at the 5300 next week, or do we move lower to the 5200? If it goes to the 5200, we probably then move to the 5200. But if the 5300 area stays, we get a little bit moved down, let's say in the gamma flip to like 5480, maybe 5450. That could be supportive for equities. Then we probably could see a bit of a rally. But if we do get the put support moving to the 5200 area, which I think is the likely scenario, we probably continue this move down here in the S&P 500. So a lot is going to be dependent this week on what actually happens with the gamma flip zone. But let's actually go to the US 500 chart, clear all the drawings, are all gone, and go on the monthly, because the month of July closed this week and it's something we actually haven't looked at. So this white candle right here is the one we're looking at. So don't look at this right now. I just want to talk about the S&P 500 on the monthly chart, excluding the last 3 days of August. As you can see, we are in an uptrend. We've made higher highs, higher lows, and making new all-time highs in the S&P 500. This is a bullish chart. However, we have seen quite a lot of volatility here at the top, but it is something that happens. We can see volatility came right here. We saw volatility late October right here in 2023. And we also saw a ton of volatility towards the end of 2022 right here. On a monthly chart, this looks very constructive. And what you really want to be doing is just buying the dip at key levels. And I think the first key level we want to look at is just the 5,000 level. It was a level where we actually parred a lot of the losses right here. And if we do pull back to the 5,000 level, I think that's a great place to buy on the monthly chart. And I think we'll find very solid support from here and then continue the move higher, because I think a lot of the macro at the 5,000 level is probably priced in. The 5,000 level is our first key level on the monthly chart. We are about 300 points away from that. Still a while in the context of, you know, the monthly chart looking very, very healthy. Diving into the weekly chart, we can get a bit more nuanced. Now, nothing really changes. The key level on the weekly chart now moves to this level right here, and we are approaching it. The reason why it's an important level is because we used it as resistance right here. It then turned into support for this leg up we saw in 2024, and we are slowly approaching it. So on the weekly chart, there is actually still a little bit of room that we can move from the 5325 to the 5250 area right here. There's a little bit of room we can move down, maybe into the next couple of weeks, into this OPEX, where we can then find support and move up higher, maybe back to all-time highs if the macro prevails. But on the weekly chart, we go ahead and actually break this level right here. Let's say we move down, find support, crack, use it as resistance, and then move down. that opens up the monthly level, and then things look a little bit scary for equities because we are in a clear weekly downtrend and we need to find support right here. The bulls need to act now, or lower levels like 5,000 become the next key areas of support. And then on the daily chart, we talked about the daily chart here in the S&P 500. We are in a daily downtrend, and on a peak to trough basis, the S&P 500 has actually pulled back about 6%, so not quite as bad as the S&P 500. To me, this still looks like a garden variety pullback. Problem is these wicks right here, these candles right here, they look atrocious. And this is just on the back of a weaker macro. The weak NFP print accelerated what we saw with the ISM numbers earlier on in the week. But we're going to have to see how the market is going to react to these yields. Fed fund futures have now moved from 2 rate cuts in 2024 to 4, right? And 1 rate cut in January 2025. So we're looking at 5 rate cuts over the next 6 or so months, which is absolutely nuts. But on the daily chart, I really want to keep your focus on these levels right here. If the put support does move down, expect more pain and expect more downward price momentum, especially if we do get weaker macro data. But if the 5,300 does hold, I think we just find support right here and then potentially begin the move up into next week. And don't forget, in the larger context of everything, the S&P 500 is incredibly bullish, and this is really just a dip buying opportunity, because as long as earnings hold up, regardless of the macro or monetary policy, we will eventually move higher. And after everything we've seen this week, we are officially back in the fear zone. But the real story here is that we are actually very close to the extreme fear zone. CNN's Fear and Greed Index really does reverberate the overall market sentiment really, really well. Just a week ago, we were in neutral territory, and now we've pushed back into the fear zone. And according to the CNN's Fear and Greed Indicator, now is actually the time to start buying the dip. You know, you buy probably here at the end of the zone, and then in the extreme zone, if you look at like key levels. And we all know the saying, be greedy when others are fearful. This week in stock markets has certainly brought the volatility, but the truth of the matter is S&P 500 seasonality tells us that that is historically normal. This right here, you can see the chart and then the average return for each and every single month for the S&P 500. And while the only negative months we do have is September and May, what we do tend to see based on this line chart right here is choppiness from about the middle of July into August and September. We normally find a bottom here in October, and then we have a blistering rally into the end of the year. Now, this is aggregate. This is not an election year seasonality chart. It's not being selective. This is every single year since the S&P 500 started in 1955. Pretty much what the seasonality chart tells us is that we get sideways chop to even downward action in this time period right here over the next 3 months. But we do want to buy the dip as long as the macro holds in there and the fundamental picture holds in there. If those two things at the very minimum come in line and stay the course, you do want to buy the dip because we will be going higher into the end of the year. But if the macro gets unstable, that's where things can get a bit dicey. I can already see the economy softening, and yes, I am a bull when the economy's strong, but I am also a realist. While I am still bullish on the US economy and the S&P 500, we do have to take things as they come. As it is right now, the volatility we're seeing in the market is historically normal, but the driver of the volatility in the here and now is the macro, and nothing to be concerned about unless the macro starts to unwind. We are seeing signs of that, but not capitulation just yet. But get ready for a bumpy third quarter in 2024. And then guys, looking at earnings today, the only two big names we got were ExxonMobil and Chevron, and it was very, very mixed. Exxon actually had very good earnings in my personal opinion. I think they beat on both the top line and the bottom line, and refining margins were really good. Chevron was a mixed bag. Permian production was good, international production was good, but overall refining margins saw profit dip. Chevron Hess deal, there's arbitration happening. It's been pushed out into 2025. There wasn't much to love with the Chevron earnings, but there was also like pockets of just like really good stuff. So very mixed earnings for both of these right there. We'll see how it affects sentiment for oil prices in the next week or so, because today was just a sell everything that was cyclical, but very mixed earnings. Nothing great to say, but nothing too bad either. And so with the recent price action we've seen in the S&P 500, in stock markets as a whole, in times like these, it's good just to take a step back and bring it back to the fundamentals just to see where we stand and where we're going. Because at the end of the day, the only thing that really matters in this market is earnings. It's the #1 driver of growth, regardless of all of the other noise. Even monetary policy, yes. Earnings governs everything, and as it is right now, S&P 500 blended earnings growth rate for the second quarter is looking very robust. Guys, Microsoft sold off, so too did Google. Both those companies produced a double beat, and guidance was in line with what our estimates were for 2024. Sure, the market was expecting more, that's why they got sold off, but the underlying fundamentals are unchanged. If anything, better. The same is true for Apple, not so much Amazon. Meta is probably the best mega cap name right now. Very mixed with Tesla, and so we could see that the discretionary space, Tesla and Amazon, their results looking a little weak, but the market as a whole, with 342 companies having reported, is reporting earnings of 13.3% on revenues of 5% growth on a year-over-year basis. That's very, very strong. The biggest growing sector on an earnings basis is comm services, followed by healthcare, financials, then technology. And on a revenue basis, tech is the only company reporting double-digit revenue growth. Estimates at the start of earnings season on the 1st of July was 11.1% for earnings, 4.6% here for revenue. Look at how we are beating them, handily beating both earnings estimates and revenue estimates. In fact, also acing margins as well. So the underlying fundamentals are really, really good. 79% of companies are reporting above analyst expectations. The long-term average is 66. But part of the reason why we're seeing volatility in the market has to do with guidance. Now, guidance isn't bad, but the 3 months earnings revision ratio fell to 1x in July, but remains above the historical average of 0.9x. So you can see, yes, earnings revisions are coming down, which means guidance is looking a little bit softer in both the 1 month earnings revisions ratio and the 3 months, but still above the historical average of 0.9. And I would say that when it comes to the year and now in earnings, the fundamentals are looking really strong for the whole market, and earnings revisions, while softening, are still looking strong in aggregate. And that's why you really just want to look at the opportunity we're seeing in the market right now as an opportunity to get long, buy the dip for outsized returns into the end of the year and into 2025, especially if we are to get the rate cuts being priced into the market right now. 4 entire rate cuts of 25 basis points each. That's a full percent of rate cuts is being priced into the market for Fed fund rate futures. That would take the current policy rate from where it is right now at 5.3 to 5.5 to 4.3 to 4.5. That is absolutely crazy, but that is the market we're in right now. 4 rate cuts are priced in, and that just means a ton of liquidity into the end of the year. And what we're also seeing is January's futures contract, some easing making its way into that. So we could be looking at potentially 4 rate cuts into the end of 2024, and then January, February, get another 1 or 2 rate cuts for potentially 6 rate cuts over the next 6 to 8 months. That is just going to mean a ton of liquidity for stocks. But what exactly does it mean for bonds? And with rate cuts now firmly on the table, the macro picture softening, we need to talk about what normally happens to yields, and we look at this from a historical context. Now, the 10-year yield leading into a rate cut in a soft landing scenario tends to fall, but the majority of the move actually happens before the Fed actually cuts rates. As you can see right here, the market actually front runs the Fed's soft landing. What we do normally see is a capitulation move here in the 10-year yield, but like I said, the majority of the move is already made, and we normally see sideways action up to 126 days after the first cut. So essentially, the time to buy bonds was about 3 months ago, but what about equities? And equities tend to be a lot better. You actually see that 1 month before, leading into the Fed's cut, we actually see about a 1% move to the upside. And after the first cut, we actually see a 3% move here to the downside. But we par those losses very, very quickly. We see 7% returns 2 months after, about 10% returns 3 months after, 12% 6 months after, and 15% 12 months thereafter. Very linear returns after a bit of volatility that we do get after the initial uncertainty. This is, of course, when the US economy did not see a recession within a year of the first Fed cut. So guys, again, you do just want to buy the dip in these scenarios because rate cuts and easier monetary policy, as well as Fed tapering, provide so much liquidity and M2 in the market that has to go somewhere. One place it goes is into the stock market. And we tend to see PEs expand in a very big way, which is the main driver of S&P 500 returns up to 12 months later, even when earnings per share falls in the S&P 500. Now, we do know that 2025 earnings are meant to be stellar, and just think about the S&P 500 returns that we're going to get when we get an influx of liquidity, PEs expand, and earnings stay robust, more akin to this line right there. The S&P 500 can see excess returns of 20-25% in 2025, all predicated on the earnings picture, however. But let's say the economy does soften, we enter recession, earnings do get revised to the downside. What this tells us is that we normally par those losses and still see upside in the S&P 500. So guys, the volatility we're seeing right now, we just want to buy that dip unless the macro gets really, really bad. And again, you'll hear it first on this channel, so subscribe so you don't miss a beat. A big reason as to why we've seen a sell-off in the last couple of days has to do with growth concerns, and those concerns are completely valid. We actually saw the Fed's Q3 GDP Now estimate fall from 2.8 to 2.5%, and while still healthy and robust growth, that is a significant move down in the Fed's GDP Now. You can see that the ISM Manufacturing Index contributed a 0.3% or 30 basis point decline in the Fed's GDP Now. And if the economic data continues to soften, we could even see GDP below 2%. And that's really going to hurt equities. That's really going to hurt the economy. And after today's NFP print, I wouldn't be surprised if we actually see this go to 2.3 and 2.2% because we saw the unemployment rate tick up in a very big way. Guys, we're at the 4.3% level right here. The expectation was actually 4.1, and this was on the back of just a weak non-farms, as well as some of the revisions we got. Terrible revisions for prior months. There was nothing good to say about this non-farm print, and the SARM rule officially triggered. And this isn't like a leading or lagging indicator. The SARM rule literally suggests the start of a recession, and it's when the 3-month moving average of the national unemployment rate rises by 0.5 percentage points or more relative to the minimum of the 3-month averages of the last 3 months. So according to the SARM rule, we are in a recession right now.